Next question. Mrs. A Limited is planning to import an equipment from Japan at a cost of 3,400 lakhs of yen. The company may await loan at 18% interest per annum with quarterly rest, with which it can import the said equipment. The company has also an offer from Osaka branch of an Indian bank extending credit of 180 days at the rate of 2% interest per annum against opening of an irrevocable letter of credit. Additional information is provided to us. Spot exchange rate is 340 yen per 100 rupees. 180 days forward exchange rate is 345 yen per 100 rupees. Commission charge for letter of credit is 2% for 12 months. Advise whether the company should accept the offer. That is a question. Please go through the question, all of you. So let us have understanding that say how to make the calculation of answer. As per the given information, first of all we try to understand the question. Let's say there is a company called A Limited. Of course it is an Indian company, that is what we have to understand, because it has imported machinery and it is required to make payment in yen currency, and the only other currency which is given is rupee currency. So an Indian company has imported goods and it is required to make the payment in yen currency. The consideration is required to be paid for 3,400 lakhs of yen. The company has two options. Either it can borrow from Indian bank. In that case, the rate of interest is 18% per annum with quarterly compounding. Okay, quarterly rate means quarterly compounding. Time value of money chapter that we were studying. Otherwise, we can take the loan from the Osaka branch of an Indian based bank. In that case, the rate of interest is going to be just 2%, like that information is given, and the time period for which they are ready to give loan is 180 days. There is a condition attached to it that say you are required to open an irrevocable letter of credit in their favor. Means if at all you default, then in that case say the bank which has provided guarantee to you, that is a guarantee to that bank, will make the payment on your behalf. We have been provided that say there is a 2% charge which you are required to pay for opening an irrevocable letter of credit. It means that say you will tell to your domestic bank to give like a guarantee to the foreign bank that if at all you default, then the bank will make the payment say to that bank. And for that, say the question is providing the information that say the commission is 2%, which your domestic bank is going to charge. Exchange rates are provided to us. Spot exchange rate 340 yen per 100 rupees and 180 days forward exchange rate is 345 yen per 100 rupees. This is the way the information is provided to us. And we have to decide whether to borrow from the Indian bank or to borrow from the Osaka branch of like an Indian based bank. So Indian and foreign, so that is the way two options that we have. Basically over here the question is silent that say if at all you borrow from the domestic bank, then what is the time period for which you are going to borrow? Of course, in order to make both the options comparable, if at all you borrow from the Indian bank, you will borrow for 6 months. Only in that case both the options will become comparable. This is what we understand. So we are required to take a decision that say from where to borrow. Is it from an Indian bank that we have to borrow, or is it a foreign bank from that we have to borrow? We have to compute repayment of the loan at the end of the 6 months for both the options, and the option which is having the lower cost is required to be selected. This is the decision making process that we are required to adopt. So let us write down answer. A few general points for the purpose of understanding of the question. First point, write down. Over here From an Indian company point of view, comma, we have to decide whether to borrow from domestic bank or from foreign bank. Full stop. Second point, in case of foreign bank borrowing, comma, there will be additional cost in form of LC, letter of credit charges. Full stop. It is to be paid to domestic bank. Full stop. Domestic bank is giving an assurance to foreign bank that in case of default, by A limited, comma, domestic bank will repay loan. Full stop. Third point, in order to make both options comparable, comma, we are assuming that from Indian bank we will borrow for 6 months. Full stop. This is what we understand. Now write down new heading. Option number 1, borrow from domestic bank. I want you to calculate what is the amount of the repayment at the end of the 6 months if at all we go for the first option of the borrowing, and of course we have to compute the answer in rupees currency. So over here we understand that say we have to work out the answer like this. Let us have some like first of all a discussion before we do answer. The spot exchange rate is 100 rupees is equal to 340 yen. The amount that we have to pay to our foreign supplier is 3,400 lakhs of yen. So this is the amount of the rupees that we have to borrow. So 3,400 into 100 divided by 340, and that comes to 1,000 lakhs. So we will borrow an amount of 1,000 lakhs of rupees. Now the question is providing very clearly that say 18% per annum interest with quarterly rest. So first quarter and second quarter. For that, so the interest will be found like this: 1,000 lakhs into 18% into 3 divided by 12. So interest for the first quarter will be 45. 45 is added to 1,000, so it is 1,045 into 18% once again into 3 divided by 12. So that comes to 470.25. Sorry, 47.025 plus 45. So it is 92.025 plus 1,000. So 1092.025. This is the amount of the repayment of the loan at the end of the 6 months. That is what we understand. So please write down answer. Working note number 1. Calculation of amount of borrowing in bracket I am writing in rupees term. Spot transaction is sell of rupees and purchase of yen. Spot exchange rate is given to us. 100 rupees is equal to 340 yen. So we understand that it is yen and rupees. 340 yen is equal to 100 rupees. So 3,400 lakhs of yen is equal to this amount of rupees. 3,400 lakhs into 100 divided by 340. That comes to rupees 1,000 lakhs. So this is the amount of the borrowing. Next, calculation of repayment of loan after 6 months. In that, friends, principal amount, it is 1,000 lakhs. Interest for quarter 1, 1,000 lakhs into 18% into 3 divided by 12. That comes to 45 lakhs. And importantly, the interest for quarter 2. So what happens that the interest of the first quarter would be added to the principal to compute the interest for the second quarter. So it is 1045 lakhs into once again 18% into 3 divided by 12. So over here 1045 into 18% into 3 divided by 12. That comes to 47.025. That is the way the total repayment. $1092.025 lakhs. This is what we understand. This is the way we are required to calculate the first option answer. Now friends, over here We can also make the computation of the repayment of the loan like this. If at all you are smart enough to understand it, 1000 into, we understand it's a 1 plus 0.18 divided by 4. Why? Because we understand that the interest is compounded quarterly, raised to 4 into 0.50. Why? Because it is the half year end, that is repayment. So 1000 into 0.18 divided by 4, that is 4.0.045 plus 1. So it is 1.045 raised to 2. So this is also the way you can compute the answer. If at all you have grip over the time value of money concepts, then this is the way you can do answer. That's okay. Not something which is very conceptual. Now I am giving explanation to you for option number 2. That is something which is important. Let me explain that to you. Now friends, over here we understand that say we are required to obtain the letter of credit from the domestic bank. Taking into account the kind of tradition or taking into account the kind of, so the way the commission amount is charged, we are going to make the calculation of the commission amount. So over here, working note number 1, calculation of commission for letter of credit. It is computed like this: invoice amount in rupees term into rate of charges into n divided by 12. Dear students, we understand that say this 3400 lakhs of yen is equivalent to an amount of 1000 lakhs of rupees. So it is 1000 lakhs of rupees into rate of charges is 2% into time period is 6 months. So friends, over here using the spot exchange rate, whatever is the amount of the value in the domestic currency, say that will be used for the purpose of calculating the commission charges. So 1000 lakhs into 2% into 1 by 2, that comes to 10 lakhs. Okay. Now working note number 2, calculation of repayment of loan after 180 days in a rupees term. Friends, over here we understand that say what we will do, we will borrow 3400 lakhs of yen. That amount will be paid to the supplier. So the account of the supplier is squared off. Whatever the amount of the loan that we have taken is required to be repaid along with the interest at the end of 180 days. That amount of the repayment of the loan in yen currency, for that say we will take the forward cover. So what will happen over here? It is principal plus interest. So it is 3400 lakhs of yen plus 3400 lakhs of yen into the rate of interest is 2% into 180 divided by 365. That is the way we are supposed to make the computation of the repayment of loan. This is the repayment of loan at the end of the 180 days. At the end of 180 days, the exchange rate is provided to us as 345 yen per 100 rupees. So what we will do, it is into 100 divided by 345. That is the way it is required to be converted into rupees term. So 3400 into 2%. So the interest for the entire year into 180 divided by 365. Why? Because we have borrowed only for 180 days. So it is 3400 lakhs of yen plus 33.5342 lakhs of yen into 100 divided by 345. that is converted into domestic currency, that is in the rupees term. So over here 3400 plus 33.5342, that total comes to 3433.5342 divided by 345 into 100. So it is 995.2273. 995.2273 lakhs of rupees. This is the amount of the repayment of loan that we will have at the end of 180 days. Now the important working friends, calculation of total cost for option 2. See, the first is the repayment of loan that we already have found. It is 995.2273. Then we understand, of course, so there is an additional charges which is required to be paid in form of commission. That is an amount of 10 lakhs. Now over here an important point comes. Suppose we have taken loan on 1st of January. Then in that case the repayment of the loan is after 6 months, 30th of June roughly. Now importantly, this commission is required to be paid upfront, because the bank will always say deduct, or the bank will always charge the amount of the commission the point at which the letter of credit is issued, and of course not it is going to be charged in arrears. So over here, so there is a concept of the time value of money which is required to be incorporated. CA Institute has made a very reasonable acceptable assumption, wherein they have made an assumption that for this 10 lakh rupees, let us say that say we have borrowed from the domestic bank only, which is charging interest at the rate of 18% per annum with quarterly rest. So we will have interest for Q1. It will be calculated like this: 10 lakhs into rate of interest is 18% into 3 divided by 12. This is the interest for Q1, and then interest for Q2. As far as the first quarter interest is concerned, 10 lakhs into 18% into 3 divided by 12, that comes to 45,000. So I'm writing over here 0.45. And interest for Q2 will be 10.45 into rate of interest is 18% into 3 divided by 12. So 10.45 into 18% into 3 divided by 12. That comes to 0.47023. 0.47025. So total of this will be the total cost for the second option. This total cost will be compared with the cost of the option number 1, and with that we are required to do the selection of the option which is having the lower cost. Please write down the answer. Option number 2 in that working note number 1, calculation of the commission for LC. Second working note is for repayment of the loan after 180 days, and that is in the rupees term. This is a calculation of the total cost for the option number 2. So the total cost is 995.2273 plus 10 plus 0.45 plus 0.47025. So that is the total cost. $1,006.14755 lakhs. This is the way the total cost will be found. So now this is the point at which we can take the decision. option number 1 and option number 2. Total cost 1,006.14755 lakhs. For the first option, it is 1,092.025 lakhs. So we select an option which is having the lower cost. That is option number 2 is selected. This is what we understand. Please write down a note for the answer. Over here, we understand that using spot exchange rate information, comma, invoice value is found and based on that, commission amount is calculated. Full stop. Second point, commission is always required to be paid upfront slash advance. Full stop. So interest on commission will be found for 6 months. Full stop. For that, we are assuming that funds have been borrowed from domestic bank at the rate of 18% for 6 months. Full stop. Small summary for the entire answer. First of all, we have understood that so the question is about an Indian company which has imported goods and it is required to make the payment for the foreign currency right now only. There is no credit period that say we are able to get from the supplier. For the purpose of making payment, we are considering say either to take loan from the domestic bank or to take loan from the foreign bank. In case of the domestic option, the answer is very simple. Using the spot exchange rate, we compute the amount of the borrowing. Then we make the computation of the repayment of the loan. 18% rate of interest is provided to us, say with quarterly rest. The second option is that say we take loan say from the foreign bank. In that, so the calculations are important in my opinion. The first is say using the invoice value in the domestic currency term, the amount of the commission will be calculated. So this 1000 lakh rupees of the loan that we have found over here is useful for making calculation of the commission. That is an amount of 10 lakhs. Second working note is quite simple. You will make the repayment of the loan in foreign currency, say using the forward exchange rate, that is 100 divided by 345, and that comes to 995.2273 lakhs. That's very simple. Next is importantly the total cost. In that, say we are making an assumption that in order to make the payment of this 10 lakhs, we are going to borrow the funds, and we are going to borrow from the domestic market at the rate of 18%. So interest for Q1 and interest for Q2 is calculated, which is added to the repayment of the principal, and that is a repayment of the loan, and with that the total cost is found. This total cost that say we are calculating for the second option is compared with the first option for the purpose of decision making. As per my understanding, that say this calculation is say quite important for you to understand, so from examination point of view, and we select the option number 2, which has the lower repayment, that is lower total cost in total.